Chapter 18, we're going to talk about accounting for not-for-profit entities. So not-for-profit organizations are going to have different characteristics than like a corporation would. So they're going to receive contributions from outside people. So it could be like they could get grants from our government. They could get donations from people like you and I. Businesses could donate them to them. And their purpose is, again, more charitable, I want to say, in nature. I mean, normally they're providing some sort of a good or a service for people that they are not hoping to get profit. Now, see, again, as I say that, though, some not-for-profits actually make profit. They just have to retain it. They don't have any owners to distribute that profit to. So they're going to keep it and then just refunnel it back into the business. So these are some examples. So like I'm kind of describing, those are probably more charitable. Like institutions are educational institutions are normally not for profit. So most of our colleges and our universities, a lot of the for-profit ones are the ones that advertise a lot, and a lot of times those aren't actually certified programs. So most of colleges and universities that we think of would be not-for-profits. Civic organizations or like school organizations, like, so say you have a boosters club at your high school, they would be not-for-profit. Like trade unions, because they collect dues, and they too would be not-for-profit. So charitable contributions, this goes back to 2020. Look at how much money has been given, $471.4 billion, coming from a variety of places. So as we look down, though, individuals still are the highest, but corporations are also donate. Foundations definitely do a lot of, that's what I feel like does a lot of donations in big dollar amounts, are those foundations set up normally by wealthy people. Bequests means it's coming out of people's estates after they die. So again, that's another way to donate money. And then here's the type of people who receive it. So churches or religion are number one, actually almost twice as much as anybody else. Education, so again, universities, colleges, a lot of people do give back to their alumni, universities. Human services, again, those are all different types of like local organizations that help people in your community. So if you think about that, I know like for us, the United Way supports a ton of local services. And then we could give to the United Way, and then they could pass it on to those different human service organizations. Foundations, public society benefit organizations, health organizations, international affair, arts, culture, humanities, so like museums and things like that. And then environmental organizations. I'm actually surprised that one's as low as it is. I feel like that's probably something that will pick up in time. Again, these numbers are a little bit dated because they go back to 2020. The framework for these not-for-profit organizations is a little bit different than a for-profit. So the generally accepted accounting principles switch up a little bit, and the financial statements need to focus on the entity as a whole, and then the reporting requirements and the nature of the transactions and all that kind of stuff would be similar for a for-profit. We'll still prepare like our financial statements and present those to donors or whoever. Again, it's just you don't have stockholders. So the first goal of those financial statements is going to emphasize the operations and the financial position of the entire organization. Then the second goal is going to be I guess following generally accepted accounting principles is that what that one's getting at? Um, yeah, so it's saying it allows for the organizations to apply the same accounting techniques as for profit, and then it's getting into some very distinct ones like capital leases and pensions and all those kind of things. So what it's saying is that our generally accepted accounting rules, we haven't switched those up for the not-for-profit. They still follow the same generally accepted accounting principles. The real difference is how the money comes in. So they are going to receive those donations from private entities or from private individuals, and there's no necessarily no transaction that happened. So it's not like you went out and you bought goods. Now you could like say your Goodwill, like Goodwill sells stuff. So I mean they would have product that they sell and they would record sales. They really wouldn't have a cost of goods sold though, because those are again all donations. So again, it'd make it a little bit different. Now sometimes when individuals give, we can put specific restrictions on. So say I do give to the United Way, I could say I want it to go to a specific organization that the United Way supports. I want it to go to like financial literacy programs. Like I can earmark it where it needs to go. Or I could say general use. You can use it wherever you want. So then that's up to the donor. So obviously that makes the accounting a little trickier, because then those monies that come in with the donor imposed restrictions need to be set aside separately from the money that comes in for general use. Okay, and then there's no specific net income type of a number, again because it is a little bit different in the that we're not really performing services or selling product and that type of thing. So these are our financial statements that are prepared for a not-for-profit. There's a statement of financial position, which would be very comparable to the balance sheet for a for-profit. There's a statement of activities, which would be very comparable to the income statement. And then the statement of cash flows, which would be the statement of cash flows. The statement of functional expenses is required, but it can be part of this statement of activities and included in that. So then we go through them one at a time. So like I said, the statement of financial position is like our balance sheet. So it's got our assets, our liabilities, and then there is no owner's equity, because again, a not-for-profit doesn't have owners. They would have net assets. And then they're going to have the assets classified as with donor restrictions or without. So then we could have cash, like cash could be without donor restrictions or with donor restrictions. So again, restricted for a specific purpose, for a specific time period, or again, it could be done. Whoops, did I skip? Okay. For again, those could be again specific to however the contributions came in. So then our statement of activities, like I said, it's like the income statement. So it's revenues less expenses. There'll be a separate column to show the increases and the decreases of their net assets. And then they'll have a final column that agrees with the change in the balance sheet. So again, it's kind of mapping out what happened during that period that then changed those net assets. So they're trying to show what they did with those donations that were received, because the donors do like to know like where that money is going and what it's being spent on. There can be temporary restrictions that that we could have. Like a transfer or reclassification without the donor's restriction. So I think it can go, like I want to say it goes the other way though, to say that if it goes from the general fund to the other to the restricted fund if it needs to. So, or like this next bullet point is saying that so say a donor specifically says, I want to give to, like let's say this is a church and they're building a new chapel or whatever. So they say, I'm donating money to that new chapel. So then say once that chapel is built, then they can show the contribution and the expense in that same period, because then now the donor restriction has been met. You know what I mean? The circumstances that it was saving up for have come through. So we would have our expenses that are without donor restrictions, so like their program services, any supporting services. So the program services would be activities relating to the objectives of the organization, and then the supporting services would be like the general and administrative and the fundraising costs. And a lot of times donors, people who give to charities, do look at that because you want like, let's say 80% of your dollar that you're donating to go to the program services and 20% to go to administrative costs. If that was flipped, you're basically just paying money for them to employ the people they're employing and not necessarily do the service that they're saying. So you do always want to check into that. Like especially like say, and I don't know any of these off of the top of my head, but there's a lot of organizations that say like they're helping our veterans or our like paralyzed veterans or different categories of veterans. You always want to look at those to make sure that most of those dollars are actually going to those program services to either like, to house them or to educate them or to, like medical rehab or whatever their point of the organization is. You want to make sure that most of those monies are going back to those people and not to the supporting services, just the people who are running the organization, because they really should disclose all of that. The statement of functional expense provides a detailed analysis of the expenses, and the categories again are going to be the same as those reported in our statement of activities, and they all should tie out. But they're going to list out those expenses according to what type of expense that they are. And then our statement of cash flows is basically the same as any company, where we have our operating cash flows, our investing cash flows, and our financing cash flows. And then when we have contributions, sometimes though they can be like an exchange transaction, in which case though we still have to be able to record that, and then those contributions would come in to increase our net assets with those donor restrictions, and then we would reclassify them out as those restrictions again are cleared. And the contributions could be unconditional or conditional. So if they're unconditional, the resources are recorded at the fair value in the period in which they're received. If they're conditional, then the not-for-profit is going to record a refundable liability, and then there's no increase in their net assets. So the conditional would be that the entity must overcome a specific barrier to qualify for it, and then if they don't overcome that, then the donor could demand a full refund of their money back. I can't think of a good example of a conditional. Well, like I guess. Let's go back to that church building example. So say that the church is saying, okay, in 5 years we hope to build a chapel, but then they start taking the donations now. Well, what if that never comes through? What if building permits don't come together and they don't end up building that chapel? So maybe that could be an example of something that's conditional. Then you would need the donors to say, okay, we've got $5 million in this building fund. Do you want it back, or can we transfer it over to something else? And then you would need those donors to approve that, okay, we're not going to build the chapel. We're going to funnel the money into, who knows, a new parking lot or to children's programs or whatever. But you would still need those donors to okay that, because, again, they gave it based on a conditional. That's probably the best example I could give. Contributed services. So a lot of times people donate their services and their times to different charitable organizations. So they're going to recognize those as revenue if one of these two conditions is met. So if the service creates or enhances a non-financial asset, or the services are specialized and they would have to be purchased otherwise. So I'm a CPA. So say I said to my church, I will donate my services and I will do all of your books for free every month. That would be an example of a contributed service because they would have to pay a CPA otherwise. Now, if I am just donating my time in the kids' nursery room so that the parents can attend service, that they're not gonna recognize that as revenue because it doesn't enhance anything and it really isn't specialized. Like really anyone could go back in there and do that. So again, it would have to be, or say you had a builder or a contractor who said, I'll build that chapel and my services will be free. That would be another example of something they should record as revenue and add the value to that building. Sometimes people will donate works of art, especially to like museums. I feel like almost all of their pieces are probably donated from governments, historical families. So that would be a very, very common thing to happen in the museums. So then they're going to just disclose those in their financial statements. Again to say who it came from and that they're going to have it on exhibit for however long or whatever. Some not-for-profits, again, like I've already mentioned, the United Way, they will solicit the donations and then at least our local United Way does that, and then they'll give it out to the local charities. So they're gonna collect the money, but they don't get to use it. So then they're gonna show it on their books as a liability until they pay out that organization that I earmarked it to go to. The benefit of the not-for-profits are that they will have tax-exempt status. So they do not file a tax, they file a tax return with the IRS, but they do not pay taxes on what proceeds of income or, donations that they do have. So there's different sections, again, depending on what type of not-for-profit it is. So these are the three different types that would be the most common. And then so they are exempt from federal taxes, normally state taxes. Again, every state has different laws, so you'd have to kind of check what state you live in. But normally they're also exempt from state taxes. They could be subject to like other types of taxes. So I mean, say like sales tax or like property tax, things like that. You know what I mean? They could still have to pay those. Donors could get to deduct it. I mean, it depends. Our tax laws change all the time, so always kind of watch for that. Now you get to deduct it on your Schedule A if you have enough itemized deductions. Anymore, I feel like it's just high income people who really get those types of deductions. those of us that are more middle class are not having enough deductions on that Schedule A to really itemize. So then we really don't get to take advantage of it. They could have a reduced cost in postage. They cannot engage. I feel like some of that law has recently changed, that they can now engage in political campaign activity. So double check that one, because I feel like they're even letting churches do that now. So that might be a thing that has changed, at least here recently. But like I said, they do have to file a form with the IRS. They just don't pay the taxes on it. And then this topic talks about medical facilities, because medical facilities are normally not for profit. I mean, and actually we hope that they're not for profit, right? Because if they were for profit, that means there's stockholders and people are getting their money. They're taking money from the services that are caring for others, and then they're profiting on it. I feel like none of us would probably be super comfortable with that. So most hospitals and patient service type organizations, nursing homes, things like that, are not for profit. So it is a different type of an accounting. So this is an accounting topic that says, it's very unique, because think about, if you've gone to the hospital, you'll get this bill. Like, so say you're there 2 nights, it'll probably be like, this $10,000 is actually probably not even, that's probably like a third of what it really is. So you say you go to the hospital and you have surgery, it's really probably going to be like a $40,000 bill. And then your insurance reprices it, and they maybe only pay $20,000 of it. So then the hospital, even though they're putting this bill together for 40 grand, if the insurance company is really only going to pay 24 grand, that's what they need to record. So they can't record that marked up charge. They need to record at what they actually are going to collect from the insurance companies. And then some hospitals also are more service based, and they will provide either free health care to patients or at a reduced cost to patients who say do not have health insurance. So then in that case, say if they're providing it free, then that's not going to be revenue. They're not going to record any revenue on those. If they're doing it at this reduced cost, they're going to just record it at the reduced cost. And then just like any business, a hospital also can have bad debt. People don't pay, and I mean, they might declare bankruptcy, and you're not going to get that money. So then this talks about, it's the same as a for-profit, basically, company, that if we have revenues from contracts with customers, so maybe we have a contract with another party to provide these patient services, we have to identify the contract, identify what are the performance obligations, determine our transaction price, and then allocate it out to the different performance obligations. And then as we perform those, we can recognize the revenue. So that's really the same as any for-profit business. They're just saying that would also follow. And again, it could be more in the medical industry that we would see that type of stuff. Okay, so that is our not-for-profit.